Hi, good morning, everyone. Welcome to our Phillip Securities Research morning call for today. We have Phillip on the ground for LYC Medicare as well as Resources Global, some technical analysis. And as for macro and sector outlook, we have Magnificent-7 Monthly, Singapore Banking Monthly, Singapore REITs Monthly, as well as Singapore Weekly. So without further ado, I'll hand over the time to Jonathan to get us started. Thanks.
Thanks, Zane, and good morning, everyone. So we just run through our usual Magnificent-7 monthly for March. Next slide, please. So overall, the Mag 7 was up about slightly more than 2% in the month, slightly better than the Nasdaq, but it lagged the S&P 500, which gained about 3.1%. Out of the seven constituents, or rather the seven companies, Nvidia continued to be the biggest gainer. It was up 14% for the month, and up almost 100% so far this year. Mainly because AI demand is still relatively strong, and they continue to churn out better products that are more efficient. In terms of the biggest laggard, this was Tesla. It's down almost 13%, and it's down almost 30% year to date, mainly because of continuing, or rather, concerns over slowing deliveries, increasing competitions, as well as a recent ratings downgrade from Wells Fargo. So overall, the Mag 7 is up about 13% year to date. So it's still outperforming the S&P by about 3% and the Nasdaq by about 4.5%. Yeah. Next slide. In terms of individual company news, nothing so much for Meta. I believe they are the second largest gainers amongst the Mag 7 companies, thanks to very strong earnings in Feb, as well as a potential US ban on TikTok, which is really boosting not just Meta but Google's stock price as well. With earnings coming in, we expect significantly improved first quarter earnings, mainly due to their leaner cost structure as well as a general recovery in digital advertising. For Nvidia, they announced their new products during their GTC event last month, which we spoke about a couple of weeks ago. The main highlight was their new Blackwell B200 AI GPU chips, which are set to replace the current Hopper H100 and H200 chips. So these chips are bigger, faster, better, and are also expected to cost a little bit more. We expect roughly about 20% higher in terms of their average selling prices. In terms of news for Alphabet, they're actually part of a consortium with Intel and Qualcomm. And this consortium is called the UXL Foundation, aimed at kind of feeding into NVIDIA's AI software dominance. Just for some backstory, whenever NVIDIA sells their GPUs, it also comes with, not really comes with, but the only way a developer can configure and use the GPUs is if they use NVIDIA's software, which is called CUDA. And so essentially what Alphabet and some of these other tech companies are trying to do is to build softwares and new tools to power AI accelerated chips, regardless of who is designing them or who is manufacturing them. So kind of making it, I guess, more open source, which is similar to more open source in a sense, but not really open source, because AMD currently uses open source softwares for their GPUs. So they're not really going all the way to what AMD is doing, but they're kind of trying to find a middle ground to fill the void there, and I guess to generate some competition and increase revenue for their companies. Most of the news actually for this month came out of Tesla. They're looking into establishing a new production facility in Thailand. So they're talking to the Thai government there, cater to the increasing EV demand from Southeast Asia. Thailand is already the region's largest car producer and exporter, with approximately $1.5 billion in investments from Chinese EV makers already. So you can see the trend that because right now a lot of your Chinese EV makers are only producing in China, whereas they're seeing significant increases in demand in the region. So it kind of makes sense for them to just set up a production hub a little bit closer, a little bit more regionalized, to facilitate logistics and transportation and all that, rather than shipping everything from China. And so Thailand or Tesla is looking to do the same. Aside from that, they are raising prices in the US and Europe for their most popular Model Y SUV by about $1,000 and €2,000. So it's quite significant because we've only been seeing them cutting prices over the last year and a half. So this could be some sort of, I guess, early indication that maybe prices have bottomed out, and they're looking to at least potentially generate higher margins from increasing its prices. In terms of demand from China for EVs and for Tesla in general, it's still looking quite dicey. Tesla actually is slowing its Model 3 and Model Y production in Shanghai. They're telling their workers to only work 5 days instead of 6.5 days. So that's a fairly 20+% drop in terms of productivity, and that's quite ominous because they're basically saying that demand is not going to be that robust as it once was during the initial ramp, and so they've got to kind of taper down the supply to at least meet the demand, or get closer to reduce the supply and demand gap. So that's all for my concerns. I'll hand it over to Helena to continue with Apple and Amazon. Thank you.
Thank you, John. I'll continue with Apple. So Apple recently is focusing a lot on China market. They opened a new store in Shanghai, a second lab in Shenzhen, and their CEO is on their third known visit to China in the past year in order to boost their presence. So Apple has remained under sales pressure. This is due to the escalating competition from Huawei, as well as the aggressive pricing from other local brands like Oppo, Vivo, and Xiaomi. So they're really actively expanding and trying to rejuvenating its retail operation in China, because they're going to issue their iPhone 16 later this year. It becomes quite important for the company to try to reaffirm its foothold in China. Nonetheless, we maintain our neutral rating on Apple because despite their effort to rebuild trust in the China market, we think the prevailing competition is unlikely to shift in the near term unless they introduce new product or try to implement really significant discounts. Moving on to Amazon. So Amazon is increasing their investment in Anthropic by $2.75 billion. So Anthropic is the creator of Cloud, which is the competitor of ChatGPT. So they will collaborate with AWS, and they will try to utilize AWS as its primary cloud provider for its essential tasks. Another news is Amazon is trying to introduce same-day prescription delivery service in New York and Los Angeles. So they're starting out with these two cities. They have plans to expand to 12 more cities by the end of this year. So we do see that Amazon is continually working to improve its fulfillment processes, which aim to increase their efficiency and decrease shipping time. Additionally, they're constantly introducing new features and seek ways to expand their revenue stream. So these focus efforts, we do see them playing a significant role in maintaining high levels of customer satisfaction. So overall, these factors contribute to their compelling, profitable narrative. That's all from me. I'll pass my time to Amber to talk about Microsoft.
Thank you, Helena, and good morning, everyone. So moving on to Microsoft, there was no major news as such in the month of March, just that the company, it announced a quarterly dividend payment for the March ended quarter. So for Microsoft, it announced a dividend payment of about 75 cents per share, and this is like a growth of 10% year over year and flat sequentially. So the dividends, they would be paid to the shareholders as of record, those who are as of record as of May 16, and it would be payable on June 13. And the ex-dividend date is May 15. So if the investor, they purchase the share on or after May 15, they will not be eligible to receive the dividend payments. And lastly, the Microsoft is expected to announce its quarterly March ended results on April 25. So we expect the total revenue to grow by about 15% year over year, and it should be continued to be driven by strength in its cloud computing platform Azure, as well as Office 365 platform. And it should also benefit from the high operating leverage focus on cost efficiencies. Next slide, please. So to conclude, for Magnificent-7, we have an overrate recommendation. And this is mainly because although there is a weak demand for tech hardwares like iPhone as well as PCs, and also the demand for electric vehicles has been weak due to the increased competition, particularly in China. But this has been overshadowed by robust demand for the AI related products, as well as most of the Magnificent-7 companies, they expect an upside in their earnings, mainly because of high operating leverage. And also the US economy, it has still remained resilient. So we maintain our overweight recommendation on Magnificent-7. So that's all for me. I would now like to pass it on to Glenn for Singapore Banking Monthly.
Thanks, Ambrish. Yep. So for the banking monthly, we'll first start off with the usual interest rates. So the Singapore interest rates or the 3-month SORA, they were flat in March, and this was actually halting the 5 basis points decline in each of the previous 2 months. So in January and in February, it actually fell 5 basis points each month. So now it's flat month on month at 3.64%. So nonetheless, it did still rise by 29 basis points year on year, but it was 2 basis points lower than the first quarter's average of 3.66%. So we should see the SORA sort of maintain at this level of 3.6% for the next couple of months, at least for until maybe the second half. Then we should maybe see a decline. For the Hong Kong interest rates, the 3-month HIBOR was up slightly by 2 basis points month on month to 4.7%, and this slightly reversed the decline of 14 basis points in the month before that. So for year on year, it actually improved by 89 basis points, but it was still 3 basis points lower than the first quarter average of 4.73%. Now moving on to the Singapore loans growth. Next slide, yes. So for the loans growth, it fell by 0.3% year on year, so it's actually sort of flat in February. And this is actually the smallest decline we have seen in 15 months. We still expect a low single-digit loans growth for 2024, as it's expected to turn positive in the second half of the year, and mainly due to the expected rate cuts. For the business loans, it fell by 0.7% year on year in February, and the loans to the business building and construction segment, which is the single largest business segment, fell 0.7% as well, while the loans to the manufacturing segment fell 5.9% year on year. For the consumer loans, it grew 0.4%, and this is the second year-on-year increase recorded since December 2022. So for housing loans, it comprises around 70% of the consumer lending. It grew 1.4% year-on-year. So we've actually seen the housing loans been the sort of the only bright spot for the loans growth for all those segments. So it has been growing at around this low single digit for the last year or so. For the total deposits and balances, it grew 4.2% year on year, as there were higher increases in the fixed deposits as compared to the current account and savings accounts. So the current account, savings accounts, or CASA proportion, it rose slightly to 18.2% from 18.1% in the previous month. We have been seeing this maintain and stagnate at around 18%, so we should expect it to be around these levels going forward. For the Hong Kong loans growth, the loans growth declined 5.9% year on year and 1% month on month in February, and this was sharper than the previous month's decline of 5.6% year on year and 0.8% month on month. Now moving on to the next slide. Yeah, this is the SGX statistics. So the securities daily average volume, or SDAV, it dipped 3% year on year to 1,178 million in March, while the DDAV, or the derivatives daily average volume, grew 24% year on year and 11% month on month in February. The VIX, which is a market index that measures the implied volatility of the S&P 500 index, averaged around 13.8 in March, down slightly from 14 in the previous month. The top 4 equity index futures turnover fell 9%, mainly due to lower trading volumes of the Nikkei 225 index futures, as well as the FTSE China A50 index futures. Notably, the Nikkei 225 actually did rise 51% month on month, while the FTSE China A50 fell 15% month on month in March. Now moving on to the next slide, we do a brief recap of the Singapore banks' share price performance in March. So all 3 banks actually share price did go up in March, with DBS performing the best at the largest increase of 7.4%, while OCBC and UOB improved similarly at around 3.8% and 4% respectively. So for DBS, they continue to be the best performer, most likely due to their dividend yield being the highest amongst the 3 local banks, as well as them providing the clearest guidance for dividend growth in the coming years. Moving on to the next slide, we've included this sort of a new segment or this outlook into the comparison of the Singapore banks. So we just do a brief breakdown of the bank's net income, revenue streams, as well as their geographical assets breakdown. So for DBS, which is the largest local bank in Singapore, majority of their total income comes from net interest income, which is 68%. And the next largest segment actually comes from their trading segment at 14%. The wealth management only makes up 6%, while card fees are only around 4%. As for the geographical segments, the assets are mainly in Singapore at 67%, and this is the highest amongst the three local banks. So Greater China is around 22%. So Greater China is broken up into two, 14% in Hong Kong as well as 8% in the rest of Greater China. So they actually hold the highest proportion of assets in Greater China amongst the three local banks as well. For OCBC, similarly, their net interest income also makes up majority of their total income at 71%. And this is actually the highest amongst the local banks, but not by much actually. So the next largest segment will be their trading income, followed closely by their insurance segment. So OCBC is the only local bank with a separate insurance business operating under its 80% owned subsidiary Great Eastern Holdings. Wealth management and card fees make up 5% and 2% respectively of their income. So geographical segments, they have around 59% of total assets in Singapore, with 16% in Greater China and 14% in ASEAN. For UOB, a similar story, they have around 69% of total income in net interest income, and the next largest segment would be their trading income. For their geographical segments, they actually have the 60% in Singapore, and they do have the strongest presence in ASEAN amongst the local banks, with 18% of assets in ASEAN countries like Malaysia, Thailand, and Indonesia. Yeah, so for now moving on to the next slide. Yeah, so we do maintain overweight and remain positive on the banks, and the net interest margins will likely remain flat in FY24 despite the higher for longer interest rates environment. But a loan growth and fee income recovery will uplift profits. The bank dividend yields are also attractive with upside surprises due to excess capital ratios as well as a push towards higher ROEs. So that's all I have for the banking sector. I'll now hand it over to Darren. Thanks.
Yeah, thanks, Glenn. Yeah, so we'll run through our Singapore REITs Monthly. We are still waiting for the interest rate cuts. So this is just an overview for the first quarter REITs results, or rather the REITs share price performance. We noticed that the overseas commercial is still lagging after it fell 30% last year. It's still further down another 23.2%. So this year, the S-REIT index performance year to date, which is the first quarter results, or rather first quarter share price performance, is down 8.8%. Yeah, so this mainly because the expectations of any interest rate cuts has been pushed back even further, so probably in the second half. And now we're expecting likely 2 interest rate cuts only, whereas we started the year with about 5 to 6 rate cut expectations. So as you noted here, the only positive subsector this year so far is the hospitality subsector, where the full year performance, we saw double-digit DPU growth as compared to the other subsectors where we saw a decline in DPU. So going forward, we also expect hospitality subsector to be the only subsector that could generate stable DPU growth. Well, the other subsectors will be still quite challenging as the growth in their top line cannot offset the increase in interest expense. Yeah, next slide, please. Yeah, so we run through the usual stats that we usually compile. So this is the 10-year dividend yield spread. It's basically, it shows how much you are being compensated above the risk-free rate or your fixed deposit risk-free asset, for example. So right now when you invest in REITs, you are getting 3.2% you're getting 3.2% for the additional risk that you take on for investing in REITs rather than the risk-free asset. So this 3.2 has been hovering around there. So it fell 0.1% month-on-month. Right now it's at minus 1.3 times standard deviation, and this is mainly because of the high yield of the 10-year dividend, the high yield of the 10-year government savings bond. So I mean that's because of the high interest rates as well. So going forward, we expect the interest rate cuts to come in. We also expect the yield on the 10-year Singapore government savings bond to decrease, and as a result, this dividend yield spread, we expect it to go back towards its historical average for now first. Yeah, so that's the first step, and after that you'll rebound further. Yeah, next slide, please. Yeah, so next is the forward dividend yield. So cost and the S-REITs price to NAV. So the chart on the right, it shows the price to NAV where it's trading at around COVID-19 lows. So this is a minus 1.7 times standard deviation away from the mean. So this just means that REITs now the share price has corrected and is trading at cheap valuations. And as a result of this share price correction and it's trading at low levels, the forward dividend yield has also increased and is above its 10-year historical average. But this does not mean that the DPU grew by a lot. It just means that the share price has corrected downwards, or rather has fallen, which is why the forward dividend yield has risen. Yeah, next slide, please. Yeah, so running through our subsector preferences, we still favor the hospitality subsector as we believe it's the only subsector this year that still can generate possibly a high single-digit growth, as it's quite challenging to generate double-digit growth similar to last year. As last year we came off from a high, a low 2022, and as a result we saw RevPAR grew by very high double-digit or even triple-digit percentage. So RevPAR, we think it will slow down this year. Probably high single-digit growth this year for RevPAR. That's our expectations. So going deeper into the figures, we saw international visitor arrivals for March 24. It's now at post-COVID levels, or rather is since COVID level highs. Right now it's 1.48 million. So this is mainly due to the Taylor Swift concert as well as the Singapore Air Show that was held. Or rather, Singapore Air Show is the last year, March is mainly due to the Taylor Swift concert. And this international visitor arrivals is only 5% below pre-COVID levels now. And we noted that the return of Chinese travelers since the 30-day visa-free entry, which was rolled out on the 9th of February, we noted that the Chinese grew quadrupled, rather, it grew 3 times year on year. And right now the Chinese, we expect it to increase over the course of the year as well. As last year, the Chinese were barely back. The return of the Chinese travelers were much lower than anticipated. And for RevPAR, we expect it to like I mentioned, we expect it to continue its growth trajectory after 3 months towards the end of 2023. It was a negative year on year, or rather decline in the last 3 months of 2023. So this year there's a lot strong line of concerts as well as MICE events. So we expect RevPAR to continue its growth. And we noted that right now it's at 25% above pre-COVID levels already. Yeah, next slide, please. So the improvement in international visitor arrivals will also help the retail sales numbers, as more travelers will likely spend, and like Chinese especially will spend at the luxurious malls, at downtown malls. So we expect retail sales numbers to remain strong. So this retail sales index figures for February is up 9.4%. That's mainly due to Chinese New Year. Because Chinese New Year in 2024 was in February, while Chinese New Year was in January in 2023. So if you combine these 2 months, the year-on-year growth, if like January and February you add together, the year-on-year growth in 2024 was about 4%. So it's still up. If you like combine, because you just kind of strip out the Chinese New Year effect. And yeah, so retail sales is still, the outlook is still good because of, like I mentioned, the international visitor arrivals improvement, as well as like the government payouts. They have CDC vouchers and NS Life credits. All these will help with retail sales. And we recently spoke to a listed company also who manages retail malls. So they mentioned that the tenant outlook, like the tenants, when they negotiate, right, the outlook that the tenants have for retail sales in Singapore is very strong. So the tenants are willing to pay for higher rental reversions. So as a result, we are expecting likely a high single digit for downtown malls and a low single digit rental reversions for suburban malls. Yeah. Next slide, please. Yeah. So this is a run through of our coverage. So the new edition is Cromwell European REIT. We just initiated it with a target price of €1.91. So this Cromwell European REIT, we also added it into our Absolute 10 portfolio. So we like it mainly because of its stable, resilient portfolio. Yes, high occupancy, about 95%. It has a solid track record of positive rental reversions, and it's leases are tagged to CPI. So in periods of high inflation, they benefit from higher rental escalations as well. And they also have a good divestment track record where they've been divesting assets recently at about 14% above book value. And they're also using these divestments to pay off some of their loans. So this is a very good capital management in our view. And the one that I want to highlight here is Prime US REIT. We keep it under review until we get more news, like especially the fact that the July, about 60% of their loans expire in July. So until this loan is refinanced, we will not change our rating back to our usual ratings. So we are just waiting for more news, as July is it's only like 3 months away, and yeah, we think there might be a risk that of refinancing. Yeah, so that's all for me. I'll hand the time to Peggy. Thanks.
Thank you, Darren. Okay, I'll talk about LYC Medicare. This company has launched its prospectus on the catalog, which shows all the listing of the potential catalyst IPO. So the asset today they still not being the prospectus still not registered. So some of the data here, especially on the listing stats, are tentative. These are just a brief rundown on the company. The company is probably going to issue the IPO at between 23 to 27 cents per share. And according to the management, the post-IPO market cap should be around 26 to 31 million Sing dollars. The company is an orthopedic and clinical service provider in Singapore. They also produce and sell nutraceuticals and ingredients in Malaysia. The Bursa listed LYC Healthcare, which has a market cap of 117 million ringgit, is a major shareholder with 64.5% stake currently. Post IPO, not too certain what the stake will be. The issue at 23 to 27 cents comprises 17.3 million new shares that will raise about 4 million Sing dollars to the company. Then there is also another roughly about 1.6 million shares to be issued to the IPO sponsor Evolve Capital for part payment of the IPO expenses. And we estimate there could potentially be 11 to 17 million existing shares which will be sold by the existing shareholders. Okay, the company, the medical services in Singapore is held under 2 brands. The one is TNT, which offers primary GP services with some screening operations. That they have 1 clinic. Then the other segment is the orthopedic, which they have 3 clinics currently, expanding the 4th clinics with the addition of 1 more orthopedic surgeon second half this year. And they're also looking to add another screening center in Singapore and to provide diagnostic services. In Malaysia, they are in a separate business of sourcing, procurement, distribution of functional food products and ingredients to help the customers, which are mainly the pharma companies, to develop brands, formulate, design, packaging, and seek regulatory compliance for new products. Currently these are mainly into the food, F&B, as well as health supplement products. For them, the growth drivers will be 1 more new surgeon joining in second half this year, then setting up the screening center in Singapore, and possibly recruiting more GPs to provide diagnostic services. And they are looking to beef up the primary care services in Singapore. In the nutraceutical business, they want to expand into beauty and animal health. Okay, so these are the numbers on the table on the right. I don't provide the FY22 numbers because they're not comparable. FY22 they only acquire part of those clinics. So 23 is a more complete picture of what is existing currently in the company. So based on the issue price of 23 to 27 cents, the market cap ranges between 23 to 31 million. And this PE on an enlarged basis of 11 to 12.9 times. These numbers differs from what the company show on their slides. I think the company has not accounted for the new shares that they plan to issue. So there's some deviation here from the company's announcement. And book value after the IPO we calculated should be about 24.2 cents, 74 cents per share. Next slide, please. Yeah. Okay. I thought probably a good way to show you how the healthcare sector is being valued across different segments of the market. Basically among the healthcare companies listed in Singapore, it's just actually two big groups. One is those who make very little profit and those who have a sizable profit. Okay. Sorry, there's so LYC really belongs to the one at the lower end of the range. This net profit have not included the IPO proceeds. So IPO expenses. So with that added in, you might see a reduction to nearer 1 million Sing dollars. And across the healthcare sector listed in Singapore, we also see divergence in terms of valuation. The smaller ones have a lower valuation compared to the bigger ones that are priced nearer to the high teens, whereas the smaller companies are traded at lower teens. And even in terms of ROE and ROIC, they pale in comparison to the bigger ones, mainly because they don't have the economies of scale. And with the Singapore rollout of the Healthier SG program, it increasingly will put the bigger ones as a slight advantage, because you have a bigger base of patients, bigger base of doctors, and therefore you are also able to grow. And if you have cross discipline, you also can do cross-reference referrals. So therefore, the bigger is likely to become stronger. So these are some of the numbers to highlight the differences. The one column I'd like to draw your attention to is the staff cost per revenue to revenue. These numbers was always on the higher end. For the smaller ones, they tend to even cross in the 50% mark. So it is again demonstrate that the bigger ones have an advantage. So I'll leave these tables for you for your reading. Thanks. I move on to the next company. Resources Global Development. They had a briefing on Monday, which I attended last Monday. They announced further acquisition of another coal mine. This time, the name is called Triop, TRIOP. In this round, they owning an effective 30.1% stake in this coal mine, which they paid $14.8 million, or they're going to pay $14.8 million for it. The deal is still subject to independent valuation and shareholders' approval at an EGM that is going to be held. This coal mine is very near to the existing 4 coal mines that they have just recently announced that they acquire. And all the 5 coal mines are connected by a road, an 83 kilometers route to the jetty. So therefore, there's no additional expenditure that they need to incur to bring the mine to production. And they expect these new mines to be operational at end of 2024, like the rest of the 4 mines. It has also produced a coal with car of around 4,000, which is a segment which the PTPLN, the National Power Plant power generator, will want to buy for production in Indonesia. At the same time, RGD is also announced a proposed 1-for-5 share split, so that they will increase their outstanding shares to 450 million. And with that, also the FY23 proposed dividend will be reduced from 3.5 cents to 0.7 cents per share. And they still have the intention to place out 10 million new shares. So after the share split, it means 50 million new shares to improve the liquidity of the company. The management states that they expect no further fund injection required to bring the mine to operation. And they think the mines can contribute positively from FY25. Also expect that these mining operations will add on to the coal shipping volume, therefore lifting the shipping income. Okay. Why the optimism over coal sector right now? We believe is also driven by this tailwind when Indonesia wants to build more smelters for the mineral sector. They had proposed to reduce their reliance on processed metals imports while raising the value of their exports. So for January 22, they had banned all the export of nickel processed nickel raw materials, and bauxite was banned from June 2023. And from May this year, we'll see copper, iron ore, lead and zinc. Zinc will also be not allowed to be exported as a raw mat. So they must be processed. And so therefore, that has encouraged a lot of investments into smelters in Indonesia in the last few years, both from domestic investors as well as foreign investors such as the Chinese. And even Freeport lately had announced an investments into a copper smelter. So all these smelting facilities require huge power generation, and therefore the big jump in demand for coal. And these materials are the essential feedstock for electric vehicle, renewable energy like solar panels, and data centers, which are the latest infrastructure developments worldwide. Thank you. That's all for me for today. I'll pass on to Zane. Thank you.
Thanks, Peggy. Good morning, everyone. I'll move on to the technical portion. So first up, looking at S&P 500, the index actually broke down below this uptrend channel in blue last week, and then following some sideways movement, there was also weakness on Friday as well. So with that, we're likely to see continuation of this recent bearish momentum to head down lower. The current resistance is around 5,145 to around 5,200 area, while the next support is likely to be between 4,980 to about 5,060 area. We also have a technical sell on Berkshire Hathaway Class B at $409.11, take profit levels at $386 and $373, with a stop loss at $420. The stop loss closed at $403.26 on Friday. So looking at the chart for Berkshire, recently there was a breakdown of a bearish flag in blue over here. And then secondly, the price was unable to hold the $414 level, which previously acted as a support multiple occasions since late February this year. So with this breakdown of these two support levels, that gives us a bearish signal, coupled with the decreasing momentum on both NEC and RSI, we expect price to pull back further towards these two lower support levels. So just a summary of the trade initiated. Currently is in progress and is currently up about 1.4%. So that's all from me now. I'll pass on the time to Paul to talk about Singapore Weekly. Thank you.
Yeah, thanks, Dean. Next slide. Yeah, so we just run through some of the macro number data that came up for Singapore. There's quite a bit here. So like Darren mentioned, visitor arrivals was still extremely hot. It's up almost 50%. So like 50% more people came compared to last year. And a lot of it was supported by China arrivals. So China is 3 times higher. Partly due to the visa restrictions removed in February, and with Thailand also removing in March. So it makes it a more attractive destination. You can move around ASEAN visa-free for Chinese tourists. Another positive news for Singapore was our FX reserves continue to pile up. We'll show you a chart later. There was this MAS, which used to normally discuss about their monetary policy statement or MP here. Usually only twice a year, but this time they're making it every quarter. Not sure why. Maybe this one will be more transparent, or maybe too free. But okay, but actually they are maintain their rate of appreciation. We show a chart later. So there's really no change. Doesn't really impact us as equity investors. But I guess if you're a foreign investor, because we peg our currency to our trading partners like Malaysia, China, and so forth. Normally ASEAN trading partners or Asian trading partners. So Singapore policy is to continue to raise the currency, the rate of appreciation for the currency. We also had our GDP it's still a bit below for our forecast, but at least it picked up from the fourth quarter. And the sectors that's helping to pull up the Singapore GDP is actually construction. Another data point or central bank, which is from the ECB, the European Central Bank. We usually don't discuss much of it, but since we have initiated coverage on Commonwealth, so this is important for the stock. So they hinted quite strongly that they're looking to cut rates by June. So they said that they are data dependent and not Fed dependent, because the expectations was that they will only cut after the Federal Reserve has cut. So they have kind of ruled that out, that they're willing to do it earlier and they don't have to wait for inflation to drop to 2. And also the most important was they added this statement that it would be appropriate to reduce rates. I mean, just another word for reduce policy restriction. And the EU inflation is also really falling very sharply from I think 9-10% to only 2% now. So there's a reason for them to cut. Most of the headlines in the US was about the core CPI is still running above estimate and still hotter than expected. Just to give you a sense, month on month was 0.5 versus second half was exceptionally weak, was like 0.1 to 0.2. So that gave the market a lot of confidence that inflation is coming down. But since the first quarter, it started to accelerate back again. Next slide. So in terms of our tactical view, of course, all the news now is about the Middle East conflict. For us, our base case is that it won't escalate from this event, mainly because this was really well telegraphed. I think I guess we all read the newspaper. Iran already mentioned this in advance, a few days in advance, just to let everybody know I'm going to attack. So there were no injuries. Most of the missiles actually just fell off before they even reached the destination. And of course, the US said that they're not going to participate in any attack in Iran. This is important because especially with the US elections around the corner, it's only going to hurt his chances if there's a spike in oil prices. So in terms of who benefits, in a way, Singapore benefits in a relative sense because we might get that relative flow because we are the high dividend safe haven for regional equities or even globally. So that might help some flows. Again, this is hypothetical. If this risk off were to continue. And of course, when you have high oil prices and with a conflict kind of reeling corporate confidence, it's going to be negative for Singapore Airlines. Like Darren mentioned, the strong visitor arrivals that are coming, the main beneficiary is Far East Hospitality because that's the only pure domestic Singapore-only hotel REIT that we have, that we cover at least. Any cut by the ECB is going to be positive for Commonwealth because Commonwealth's interest rate is dependent on the euro, depending on European rates. So they peg to it. I forgot what's that term, but anyway. Yeah. We got lots of questions of Seatrium. There was one question of Seatrium yesterday, so we thought we'd just try to address it and give our view. So Seatrium, of course, moves in line with oil price. It's a proxy because of the huge volume for this share price. But fundamentally, we are cautious. So there are a couple of reasons. So in their most recent guidance, this is not guidance, this is more like what they hope to achieve. Even their 1 billion target EBITDA, you're still looking at very slow growth, about 8% growth. And after 5 years, the valuation taking out depreciation, you still have to pay taxes, not just EBITDA. You're talking about only 10 times PE in 5 years. Second thing is the net debt is going to also triple. So whether they're going to do any more equity raising, we're not sure. But when your market cap is 3 billion and your debt is 2.5, I mean, it's also a bit of a worry. But anyway, the problem is that it's not that they're raising debt to fund growth like capex, build new machine and so forth. Almost 800 million of it to 1 billion is actually non-operational cash drain. So they got like almost 600 million of legal claims. The car wash here, car wash got to pay Brazil, car wash also have to pay Singapore authorities for fines. Then another 200 million because of the merger. You still have to close yards, but you close yards, you cannot just walk away. You have to restore them. So at least another 200 million. Longer term could hit additional 500 million, but I think that's for the existing yard. So this is the one, within the next 5 years, they will come another 200 million. Then of course, Keppel still have another 1.3 billion of shares to sell. And actually, for us, the issue is actually, at least for us, we think that their cost base is still high. So even their target of 9% to 10% EBITDA is actually less than half the Yangtze 23%. So it kind of implies that even all this merger, the cost synergy, revenue synergy, I mean, you do so hard the next 5 years, your EBITDA margin is only less than Yangtze and also far away from the last cycle high, about the high mid-teens to high teens. So these are the reasons. But again, if the oil price move up, this stock will just move in line. So, but this is just our fundamental view. In terms of some of the events coming up, will be a lot of the banks coming, and on the 18th will be Netflix results. On the 16th, Jerome Powell is also going to be making will be some panel discussion. So it'll be interesting what he says, and yeah, on the 16th. For this week, we have quite a few events. So we have the ISO team. If you want to know more about the construction industry, especially this company specialized in restoration, repair, maintenance of all the HDBs, and this is like every year they have it, because every 5 years the building needs to be repainted. Then the marine sector is very hot now, so if you want to know more, on the 18th you can dial in. Then later in the day we have our US strategy 7:30, and on Saturday we have our usual quarterly Singapore strategy. Now, feel free to attend, so it's open to anyone. Next slide. Okay, so just as a graphical illustration, the left is just to show you the sharp recovery in tourism that we have. It's only, and also on the right is the strength of the currency, because the FX reserves continue to pile up. It could be more because MAS also transfers some of these FX reserves out to GIC. We won't know until when their annual report is out. But I won't be surprised if they actually took out some of the reserves. So if they add that back, the line should be, I don't know, at least another 100+ billion to be added, or 100+ billion to be added. So you're talking about more 400-500 billion of reserves. If you to add in all those that they transferred out. Next slide. Okay, this is the confusing chart that we always show, but this just for example. Think of it like probably if you are from regional countries, Malaysia, so forth, then that blue line more meaningful for you, because the blue line is where the Singapore MAS wants to appreciate the currency against trading partners, which normally China, and the red line is actually US dollar. So it doesn't mean that when the MAS push the blue line, that the US dollar follows. So US dollar, of course, has its own global flows and so forth. But just to explain, in general, the default setting, that means what the MAS usually does is the white space that you see, is always to increase slightly the exchange rate, the blue line of the Singapore exchange rate. It's like the trade-weighted exchange rate. Then when inflation is very high, you get this blue bar here. It's called recenter upwards. That's where the Singapore MAS will gap up. You think like a share price, suddenly just gap up, right? So they're just going to gap out the currency. So that's why you see here on the right here, the far right, the blue line, there's a very sharp spike in 2023, or actually more 2022, in the exchange rate because of inflation. Our currency strengthened very aggressively. Then green means zero appreciation. That means we usually want to weaken, and maybe growth is slow. Like the pandemic, you see in 2020, 2021, the pandemic, then we kind of slowed down the currency. Then during the recession years like 2008, 2009, you see this orange bar recenter downwards. Of course, we hardly want to do this to go and weaken the currencies, like gap down the currency. So that's very rare, but that is what usually that happens when we are in a recession and so forth. Again, this is for information only, and just for your reference, so that you can kind of understand when it comes to MES mix kind of like all their kind of statements. Next slide. Okay, so this is the caught all the news, which is the US inflation on your left. So you can see that things are starting to turn up. So after sliding down the red line, you will notice it's starting to flatten out and move sideways. So that's the worry now, that inflation is going to be hard to come down. So services is the one starting to pick up, especially when you have strong employment. And likewise, energy is also picking up. And energy not only has the influence on CPI, it also affects core. So core inflation means on the right here, excluding fuel and all that. So that alone can actually drag up inflation. So that's the worry here. You can see the blue line and the red line actually kind of move in line, and gasoline price is starting to climb back up again. So that could actually pull up inflation, kind of delaying the Fed's interest rate cuts. Next slide. So again, we usually don't talk about ECB, but since we have a buy call on Cromwell, so right now the one on the left is the inflation is the red line. So you can see it's dropped very sharply. It used to be even more than 10% in Europe, but now it collapsed even lower right now, lower than the US inflation. So it gives the ECB or the European Central Bank cover to cut rates. So the rate cut that they did was very aggressive. You see the blue line, it used to be negative, below 0. Then it went up to 4. So there's room for them to cut. And one way to gauge how tight monetary policy is you take into account interest rate and the current inflation. So you can see that I think it's yellow. The yellow line is actually the highest in 23 years. So it's the tightest monetary policy in 23 years. So that's why there's a lot of reason why the ECB can cut, because it's very tight right now. And also industrial activity, we just use Germany. We added Japan because this chart, I did it together, so I just left it there. So, but if you look at the industrial production, it's actually quite weak. It's going negative. So industrial production, think of it like manufacturing activity in Germany. The blue line is actually turning negative. So it's also another reason that growth is slowing. So for ECB to cut rates in June. Next. Okay, yeah. So that's it for us. So thanks everyone. We can move on to Q&A if there's any. Thank you, everybody.
Yeah, thanks, Paul. There's a question here on the US market. US market seems to be still wild and volatile last week. What is your view? Yeah, so we'll continue to expect some volatility to come into the market, especially after, making new highs, basically week in and week out. I think the S&P is up like, this here just from a weekly standpoint. Sorry, put that here. I don't know how many weeks in a row. Or rather, it's like maybe 15 weeks, making new of weekly gains with a couple of kind of flat weeks here and there. But essentially, the trend has just been so strong that it's natural to have some pullback, and especially with the volatility, like Paul said about the Middle East conflict, kind of, I guess, seemingly intensifying a little bit. A bit of volatility in energy prices as well. It's just flowing straight into the market. Probably why you saw gold prices run up quite a bit as well. Yeah, but we continue to expect this to persist a little bit. I mean, especially if we go into the second half of this year. I mean, it's a bit far away, but as elections start to kind of get a bit clearer with the front runners going up against each other, you probably start to see even more volatility going through the market. Yeah, so we think that this will still persist for a little bit longer. At least given the I guess uncertain macro backdrop on multiple fronts. Yeah. So let me check if that's all for me. I think that's all for me. I'll hand it over to the rest of my colleagues for the rest of the questions. Thank you.
I think there's a question on Apple and their software to incorporate AI. Yes, Apple is preparing to incorporate AI into their new operating system, which is the iOS 18. So they're actively looking for a partner for their generative AI, which mainly is for including their features such as creating images and written content based on prompts. So they are right now actively discussing with Google's Gemini. They're also in talks with OpenAI. And also within the China market, because in China, all the models need to be vetted by China's cyberspace, a regulator, before being introduced to the public. So they need a local generative AI provider. So they're talking to Baidu as well. This is going to be a major win for whoever that gets to work with Apple, because they will manage to get onto Apple's ecosystem. And of course, there's going to be a major license fee. And for Apple itself, it would definitely give them the ability to double down on their AI ability. Because right now their AI is currently being developed within Apple Park. So with the collaboration, they're going to make sure that their iPhone 16 will be a potential game changer with AI functionality. But so far, nothing has been settled yet. So they have not really decided on the terms of what the agreement is going to be like. And it's unlikely that any deal will be announced until June. So that's Apple's WTC is going to happen. It's also possible that they didn't reach agreement with any of the above parties mentioned. They might also choose another partner. So nothing is really certain yet. So we don't really know how that's going to affect the price. So I hope that answers your question. I guess that's all the question for me. I'll hand over my time to my colleagues.
Yeah, there's one question from me. Besides hospitality and retail REITs, which will be the next best REITs? Thank you. Yeah, so other than these two, we have office and industrial, and of course we have healthcare. So, but healthcare is just that two stocks, First REIT and Parkway Life. So, after these two, we have office. We are not too positive on office, mainly because right now, office rents have kind of plateaued over the past year. It grew very slowly, like 5 cents per square foot over the course of the year last year, and now it's at 11.90. So going forward, there's a lot of supply incoming this year from IOI Central Boulevard as well as Keppel South Central. So if you add that up, there's almost 2 million square foot of supply incoming, and we don't think that demand can absorb all this incoming supply. But I guess the silver lining for this office is that a lot of the Singapore office landlords like Suntec Keppel REIT, the rents that the passing rents in the portfolio currently is still not quite at the average of the CBD core CBD market at 11.90. So for individual these office REITs, there still might be potential for some slight positive rental reversions in the portfolio. Yeah, for industrial is similar, where the incoming supply is about double of the past 3 years average. So it's about 2 million square meters of supply incoming. So we also don't think that the demand can absorb this supply. And furthermore, industrial REITs were the best performers last year, and as a result, their share prices were also at a higher level, dividend yield wise. So if you look at dividend yield wise, the industrial REITs are the lowest in as compared to the other subsectors at about 5.7% on average. Yeah, so that is the next two. Yeah, I think that's all for me for today. Yep, I'll hand over the rest of my colleagues. Thanks.
Okay,
Hey, thanks, Aaron. Yeah, Peggy, I go ahead first. Okay, thanks. Yeah, one just came in about the UOB. So I'll just read the question out first. UOB cut their deposit rates ahead of US higher for longer interest rates. Do you see their CASA fall and impact their net interest income and net interest margins? Will this impact their net profit negatively versus their competitors? Yeah, very good question. I think this question that's been on everyone's mind. So UOB, just some perspective for those who are background on what happened for UOB. So they did cut their one account, which is their flagship current account, savings account interest rate. So they cut it by the effective interest rate. If you hit the full cap of running, now they increase the cap from 100,000 to 150,000, but they cut the interest rate from the effective interest rate at least from around 5% to around 4%. So it's quite a significant drop, 20% of the interest rate. So how would this affect their CASA? So definitely their CASA would move out, due to maybe fixed deposits or other higher yielding interest accounts. But if you look at it, and look at their peers, at least, DBS and OCBC, UOB still has one of the most attractive sort of high interest rate current accounts, savings accounts out there right now. So I think they have sort of look at their competitors, and the environment and said that maybe we are too high, so they are cutting it down slightly, but still remaining very competitive with the rest of the banks, right? So I don't think that their CASA would fall drastically. I think on the ground, people are saying that they would still maintain it there because it's the easiest to hit, the least loopholes to go through. You just need to spend on the card and I think do a salary credit or something to get that high interest rates. So, and of course, it's your current account, so you can withdraw your cash anytime, unlike a fixed deposit. And how would this affect their net interest income and net interest margins? If anything, I think it would improve both of them, because what's happening now for all the banks, not just UOB, is that their funding costs have been creeping up. So all the high fixed deposit that they took in, right, about a year ago, is starting to eat into their margins. But their loan yields are not increasing any higher because the rates have sort of have kept at high levels. But this sort of high funding costs which they have taken on has started to creep in more and more. So all three banks have said that they have too much deposits and the loans is not growing. So they don't really have anywhere to put these deposits. So they have a lot of excess deposits and funding. So they're looking to release some of them. One of those ways is to release the fixed deposit. So when the tranches of the periods are up, the tenors, then they will just not maybe provide or give as good of an interest rate as they did before. And they'll just they're okay with releasing some of them. I think the banks have all said that they're okay to release. I think UOB is the one that said they're okay to release it because it's too expensive for them. So how would this impact their net profit negatively? I don't think it will be a negative impact. It might actually be a positive one because it will improve their margins and they don't need so much deposits, right? So their cost will go down, but their revenues and incomes will still remain high. So this will actually could possibly positively impact their net interest income, net interest margins, as well as their net income. And I think the other banks, I think maybe someone will ask this question, but the other banks might also see an opportunity to cut their rates. But then again, they don't really give as high as UOB. So UOB were the first to increase, and now they're the first to decrease their rates. Hope that answers the question. I think there's one more on SGX, but I'm not sure if this is on the company itself or on the overall Singapore exchange. So it's asking about what is the effect on SGX via vis-a-vis the current Middle East political situation. Yep. So for SGX wise, the company, the one that we cover, I would think that due to the political situation, volatility would increase, and this might have benefits for their derivatives line, which has been actually in a decline for the last almost a year. However, and this will also increase their trading volumes, but it's really hard to say. And I think, yeah, that's all I can say about the SGX. Okay, that's all for me. Hopefully the answer is sufficient. Thanks.
Thanks, Philip. Take over. There's a question on capital. The question is, any views on possible reasons for CapCorp to substantially drop today in comparison to the other blue chips? I think in my view is probably got to do with the Keppel's exposure to Keppel has stakes in 5 listed REITs in Singapore: Keppel REIT, Keppel DC, Prime, Core, and KIT. So the higher potentially higher interest rates, the prices of these REITs have also fallen. So on a sum of the parts calculation, Sembcorp's cap valuation would also fall in line to reflect the lower prices of their stakes in the REITs. And I believe that is the reason. Other than that, the core earnings which is generated from power are still enjoying very good returns because they have substantially most of their contracts secured on a long-term basis, and gas prices are actually on a decline. Although the prices of feedstocks does not really affect their profits, but it means the consumption, the demand for power will still not be affected. Will not be impacted by any higher prices. Yeah, thank you. The second question for me is hi Peggy. Thanks for your LYC's table comparing to other players. With reference to RGD's proposed 1-for-5 share split, what is your view on when is a good time to enter? Okay, theoretically, when they split the shares, it means the share price will also drop by, and it will also be divided by 5. So theoretically, the share split shouldn't be affecting the performance of the shares. But if your question is about the coal mine, then Then there are a few things to think about. One is they only starts operation from 2025, so the earnings will only come in 2025. And roughly, assuming they can produce 2 million tons, they book 2 million tons of sales, and on a 30% gross margin, then we see that at the bottom line that may contribute another 25 to 30 million to net profit. Right. But there's again maybe from 2026 onwards. So it's still a long way out. But the reservation that I would have is that they don't directly control these coal mines. The stakes are through subsidiaries and JVs and so on, which they don't have board seats at those level. So they do not have control of the operations. And this is the first time they move into this sector, even though their directors are knowledgeable in this business. There's still a little bit of discount you need to apply in case anything don't turn out according to what they plan. So I think the good time is to see them producing some kind of confidence, giving us some kind of confidence that the project is taking off as planned. Yeah, so maybe towards the second half of this year. Thank you. I think that's all for me. I pass back to the rest. Thank you.
Thank you, Peggy. So there was one question for me. So what is the future growth of Adobe? Have they harnessed AI to beat Chinese clones? So basically, in the most recent quarter, Adobe, its revenue, it grew by about 11% year over year. And most of its revenue it's generated by its Creative Cloud offering, which basically offers softwares to edit and video, to edit the images or videos. So for the March ended quarter, it expects its revenue to drop to about 9.5% growth rate. And this was mainly because of the tough comparisons. So management highlighted that the price increases that they have announced in the year 2021 or maybe 2022. So they hit the majority of customer base last year, and they have now started to roll off. So as a result, its growth rate is expected to drop to 9.5% in the March ended quarter. And the company, it has also introduced AI across its product base. So like it's the AI tool, like which is a Fearfly. So through that tool, the user, it can basically generate images via text-based prompt. So it has integrated AI, but we are not too sure if it can it can boost its revenue for this year at least. And we need to see, also wait and see, mainly because it's currently offering a free tier for its services, and we need to wait and watch how early or how sooner it can convert those free users that use the AI tools to a paid user base. So overall, for the full year 2024, we don't expect a significant revenue growth, and we expect a revenue growth in line with the previous year, which is of about 11% growth rate. And we have overall we have a reduced recommendation on Adobe with a target price of $465. So hope that helps, and would now like to pass it on to the rest of my team.
Sean?
So with regards to this question, with interest rates continue to stay high, is it time to invest in bonds and long-dated treasuries? And what are the anticipated risks? So I mean, for this question, I believe that short-dated bonds are still a good buy at this moment because the yield curve are still inverted. But for longer-dated treasuries at this juncture, you could start to pick up a few durations bonds between 2 to 5 years from the market when the prices are low. Because subsequently, when the yield curve starts to pick back up, then the yields for the longer dated bonds will continue to go up and higher. So I mean, for now, since inverted yield curve are still in place, then I'll say that shorter dated bonds are still the way to go for at this juncture. Then perhaps once you reach the third quarter of this year, then when interest rate starts to stabilize, then you look more in towards the longer dated bonds. Yeah, hope that answers your question. Thank you.
Yeah. Okay. We wait for there's a cybersecurity question, Ambrish. Yeah. We'll wait for you. Any just on the question. Forgotten which question is that? Yeah. The question on the oil price rise. Sorry, will oil price go higher post Iran attack? It doesn't seem to, because it's not escalating. We can only guess. It seems to have the so-called tension since they're kind of phased out for now. So that's the only answer we can give. I mean, post attack, unless you get this retaliation, then it seems to have kind of hit a plateau in terms of the tensions there. So that's why we don't think it probably is starting to move sideways rather than go up. Again, this is all guesswork. Anything can happen even as we speak. The other question was on the SGX thing. It's really answered, so I can't find it. But anyway, like we highlighted earlier, for Singapore market, we in terms of stress, we tend to outperform better. I think we saw it when the kind of the pandemic happened. I think when there's times of stress and so forth, I think Singapore market tends to outperform again, like I highlighted earlier, because of our so-called safe haven status. But when in times of growth, then of course we will underperform. We are always considered like a low beta, high yielding kind of market in general. Okay, thanks.
Thanks, Paul. So, with respect to the cybersecurity question, which would your analyst consider the strongest cybersecurity stock in terms of cash flows on low debt with good product offering? So, in terms of cybersecurity, the two key companies would be the CrowdStrike and Palo Alto Networks. So, for CrowdStrike, the revenues, they have been growing by over 30% range, and the company, it's not expecting a significant drop in its revenues, at least for the March ended quarter. So it expects a revenue growth of 30% in the March ended quarter, whereas for Palo Alto Networks, the revenues, they have been growing by about 19% in the fourth quarter of December 2023. Whereas the company, it's over the earnings call, they have said that the company, it's witnessing macro pressures, and most of its contracts from the US governments, they have been delayed. And as a result, it expects its revenue to drop by about 14% range in the March ended quarter. So it's expecting more headwinds in terms of macro headwinds. Whereas for for CrowdStrike, it expects revenue growth to still grow by about over 30% range. So we would prefer CrowdStrike in place of Palo Alto Networks. So hope that helps. Thank you.
Yeah, sorry, there's one more question here. Of the Magnificent-7 mega caps, which would you consider the cheapest price to book or PEG ratio to buy? Yeah, so we don't use price to book, nor do we use PEG ratio, but just based on quick calculations, if you want to use the PEG ratio, the cheapest ones would probably be either Meta or Nvidia. If you look at forward price earnings for Meta right now, it's like 22 times. Nvidia is like 35 times. And then if you expect, forward earnings to grow for these companies, for Nvidia would probably be more than that. And so both of these companies, your PEG ratio would be less than 1. Whereas the rest of them, like Apple, for example, and it's trading like 26 times, earnings probably not going to grow that significantly. That be on the flip side would probably be them and Tesla. Tesla right now trading 60 times, so a bit high. So based on your PEG ratio, if you want to use that metric, the two cheapest would be Meta and Nvidia, and then the two more expensive ones would be Tesla and Apple. Hope that helps to answer the question. I think that's it for me. I hand it back to the rest of my answer to these questions.
Peggy, you want to take something?
Okay, I think there's a few questions here. Let me do this one first. Tourist numbers are up, air travel is increasing. Why is SIA down? A few things. There's at SIA, if you look at the tourist arrivals of up 45% in year-on-year in March, but it's not mirrored in the SIA's numbers. In fact, SIA's volume, we don't have a March numbers, should be out by today. The SIA's volume year-on-year is only up about 30%. So it's actually trailing behind the Singapore growth, and even trailing behind Changi Airport's tourist numbers, passenger numbers, suggesting that the flights that carry the passengers in and out of Changi actually taken up by their competitors. Like most of them are like your Emirates, which are very aggressive, Tata Airlines as well. So that's one thing. Second thing is the SIA's valuation wise already trading at a premium to the peers. So I think there's some adjustment in terms of valuation as the peers do the catch up. And third thing is the jet fuel prices are on the way up now. Year to date is up, I think nearly about 20% for jet fuel. And of course, the final thing is that when it comes to a war, there will be diversions of flights. That means you need to incur higher costs, higher traveling time, higher jet fuel consumption, and then there could be cancellation of flights. So then you and there will be some disruption in terms of your schedule. So when there is a geopolitical tension or war, typically all the airlines should be reacting negatively to the situation. Thank you. The next question is, when will the direct negotiation of Brazil project P3856 out for C-Trim, as mentioned by them 2 months ago? We don't have a timeline for this negotiation, but like you pointed out too, it's been a bit taken a bit longer. We think we have to do with the project car wash or the corruption, the bribery investigation, which is just announced a conclusion just 2 weeks ago. So certainly not sure when this will be the results will be made known. As soon as we hear anything, we'll post it on P3. Thank you. Is Mermaid Maritime, is it good? Is it good to buy now? I haven't done enough work on Mermaid, but I'd like to caution a little bit on this sector. Just more than a week ago, the Saudi Aramco actually asked some of their suppliers to stop to halt the rig, to stop leasing the REITs, the rigs. Those affected, all those that have been affected are across the sector, including CNOOC oil field services, some of the big ones, including some of the Malaysian listed ones as well. So Saudi Aramco is also a very big customer of Mermaid, and that they also do the support services for them. So there is some uncertainty with regards to this sector right now because we have these big single customers. So and the sector the one if you recall 2014 2015 when oil price came down, the whole sectors got like washed out for what they're doing. And then at that time, their biggest competitor in this region was Sapura Energy, which was investing very heavily. So Sapura is still now still trying to find their feet and come back, but once if they were to restart their engine, I think they could see some big competitive pressure for all the subsea players, offshore drilling, etc. So another factors that drove the sector during the good times was the very high oil prices, which was more than $100 then. So maybe we are approaching there. We're not sure yet. And that time also interest rates was so low that there's so many easy money involved. So there were it was easy to put in money to build new vessels or new equipment to ride the uptrend. But now that with the cost, the higher interest cost, mermaid really need new equipment to bring up their profit. And investing in new equipment is going to be very expensive. And leasing from the market, the price for leasing has also gone up because of the increased level of activities. So sorry, I don't think I really answered the question whether it's good to buy now, but there are a lot of moving parts currently in this sector, which I would like to maybe bring to your attention. Thank you. Okay, hi Peggy. When will the EFR for KIT be launched? And what do you think will the price of the preferential offering be? How about the offer ratio too? Thank you. Yes, there was some footnote in the announcements. I think maybe just font size 2 or something, which they highlighted his numbers. I think the EFR had to be launched, announced fairly soon. I believe they try to announce it before the AGM so that it falls within this year's yeah. So we think it might happen in the next 1 week. That's my guess, right? The price and the ratio, I have to open up my file to check. Maybe I can come back. I'll type the answer to you on this one later. I think this. Okay, maybe the last question. How you think of REITs International? I think, well, I presume this is a fundamental question, but maybe Zane can also do a TA later on REITs. Well, REITs is when the oil price is up, the price is up, the share price goes up. But typically, if you are bullish on the oil price or you think the price is going on uptrend, we rather think it's better to buy an ETF, an oil ETF, than to get into REITs. Because why the risk is that for this oil exploration and production company, the development company, they spend money to dig and to look for oil. And then if something don't work out according to their plan, the projected forecast, they have to write off that investment. So it happens again and again. It happens to REITs many times. It also happened to people like RH Petrogas. So it's more like a gambling, a betting that whether it's how the cards will turn out. So REITs and all these are run by geologists who are very familiar with the field, but still yet there's a very high element of guesstimates in their results. So yeah, I don't know, I can't get myself to invest unless it's trading at a very, very deep discount to the book value. Thank you. I'll pass back to Paul, maybe. Thanks.
Okay, thanks. I think I'll just try the Bingquan one. I haven't seen it for a long time, but I'm not so sure whether is it realistic because the market cap now is about 30 million, 30 plus, almost 40 million if I'm not mistaken. 30 plus million, then their book value is about 10 million. They're making, I think, 2 million profit. So I'm not sure. I think when it was, because the share price has doubled, maybe before that there could have been some value. But I know it's an ultra micro cap. So and it just ran up, I guess, together with all the oil and gas names. But at this current price, I'm not sure where the value is. The theory is that they are doing work for FPSOs. So I'm not sure. I'm not sure why would anyone chase after this, because there's a lot of minority interest. So they a lot of the earnings is diluted because they don't really own a large stake in these companies that's generating all the profit. So yeah, I'm a bit more hesitant. Yeah. Okay, I hand it over to you, Zain. Yeah. Maybe this last one can Darren and Glenn answer this one. Then we hand it to Zain. Yeah.
Yeah, I think is it the one on the counters
Dividend, yeah.
to
Dividend,
recommend? Yeah,
Yep.
we're looking for dividends, but with sufficient holding in banks and REITs. So for the banks, I'll speak on that first. I think for banks, mainly you look at DBS. So DBS currently with their projected the one bonus 1 for 10 share issue, as well as with all the incremental dividend increment they're giving yearly, you're looking around 6.7 to 6.8%, depending on what the share price is at. Yeah, so I think for banks wise, DBS would be the best. You can also look at OCBC if you want some diversification. So the OCBC is around 6.5, below 6.5, I think 6.2, 6.3%. Yeah, so if you don't want to put all your eggs in the one basket and go into DBS, then you can always also go in with OCBC as well. Because OCBC, dividends wise, they are, I mean, they're not as forthcoming with how much they're going to increase it by, but there is a bottom line of 50% dividend payout ratio for them. So we're looking around above 6% dividend yield for if it's at 50%. But if they do increase it, which they will, I would expect they have to do it some way because they have to lower their capital. So that would be one of the ways that they could do it, by increasing dividends. So that is more of slightly riskier because you're not sure how much they're going to increase it by. Yeah, so for banks wise, if you're looking at purely at dividends, I guess it will be both DBS and OCBC. Over to you, Darren, for the REITs one.
Yeah, thanks, Glenn. Yeah, for REITs, we will recommend Cromwell European REIT. So first of all, their forward dividends is about 10%. So that is after accounting for the fact that they will have some absence of income from some of the divested properties and some of the assets that they are going to undergo redevelopments. So after accounting for that, we expect DPU to drop by about 1.5 cents. So as a result, the FY24 forward yield is still about 10% at current trading price. And yeah, so we think that is a good play for dividends. And the only thing you have to take note is that you'll be affected by the euro and some FX risks. Yeah, but 10% we think is a good dividend yield and a safe play. Yeah, I think that's all for me. I'll hand over the time to to Zain. Excuse me. Thanks.
Okay, thanks, Darren. I'll start with the technical. So first up is Apple Corp. So looking at the chart wise, recently there has been some pullback in terms of price. I think short term wise, could go down towards 680 to 695. This zone over here previously, and then it will just start to sideways for a little bit after. But for now, short term wise is bearish because actually broke down of these trend line support over here, as well as this key support at around $7. which is make price go lower. Yeah, so the next question is on 1038 Hong Kong, which is CK Infrastructure Holdings. So I think looking in terms of the chart wise, generally it's quite range bound, but some weakness recently because after a series of lower highs being formed on Friday, this low at around 44.50 was being taken out. And currently we are booked below this higher low. So in the short term wise, I think expecting a little bit of a further pullback towards this key support close to about 42.20 over here. Then the share price might just do a bit of a sideways afterwards. Yeah, so yeah, a bit weakening of the range bound trend recently. And next one is 579, which is Beijing Jingnan Clean Energy. I think for this currently is in an uptrend, but I would say I think currently that it has met some resistance from this uptrend channel over here. See price pulling back slightly. So I would think some sideways action is quite likely ahead to retest the prior resistance that got as a support at 175, 176, which there was a swing low over here. So yeah, you just trade sideways for the time being. Okay, what's your TA view for AMD, Qualcomm, TSM, and Google? Okay, first up, looking at AMD share price of the trend currently still remains quite weak. After a period of a sideways consolidation over here around 166 to 171, 172. Price went lower on Friday to retest a previous range support level around 160, 162 about there. Yeah, so I think for now there could be some slight bounce, but I think it's likely to be a very small bounce. With resistance coming in around 166, 167 probably again, given the current trend, which is still showing price action is quite weak. The next one is on Qualcomm. For Qualcomm, I think generally for now, it should be consolidating in the range currently. So still resistance above the 173 to 177 area. But positive thing is that price is still forming with some higher lows along the way. So I think the key will be to see whether the 170 low over here this low is able to hold. Then if you can, then I think it's still quite positive to trade in the range. If it breaks below this 170 level, then I think expect some will be a slight weakness towards like 166, 167 for the time being. Okay, then next one is on TSM. Okay, TSM I think it's currently possibly consolidating in this channel over here. Yeah, so still quite a lot of resistance above 146 price. Yeah, unable to get a foothold over it. Then on Friday it turned down a little bit. So I think for now the immediate support is probably around 139 about there. This channel support as well as the recent lows over here as well. So yeah, we just a little bit pull back a little bit further, then just do some sideways for a time being, continue to consolidate this channel. Okay, next one is on Alphabet. Yeah, so for Alphabet, I think currently the trend is still pretty strong. Recently we saw price broke above the previous highs, 155 over here, and some sideways consolidation before moving higher. So I think potentially it could just be following in this channel over here for the time being. Yeah, so currently it's at the resistance around 161. So perhaps some slight pullback with support around 155, 156 again. Then you could just trade within this channel itself. Okay, then next one is on Snowflake. And so for Snowflake, I think for now, looks like this support at 152, 153 is still holding, but I think still expecting some lower highs, I guess. Because previously, from the first bounce over here, we had a high of 168, and second time reached about this 156, 157 over here. Then we had another bounce over here. Yeah, so I think overall you're still seeing a trend of lower highs along the way. So I think for now it might still be some sideways around here. If you can hold the 155, 156 level, and then maybe some sideways, but I would expect a lower high below this 165, 166 level. Okay, the next one is on Fortinet. So for Fortinet, I would think generally it's still quite range bound. Still finding resistance around 73. Currently reaching a level of support at around 65 to 66. So I think we could see some slight bounce over here, but I would think likely there still be some short-term resistance around 69, which is this support level which price just broke down recently. So perhaps some sideways trading for the time being. Okay, the next one is on Datadog. For Datadog, it's relatively range bound as well. So recently price rebounded from the support around 119, 120, cleared the resistance at 125, 126. And so I think for the key now is to see whether this resistance breakout is able to hold. If it does, then I think can expect some further bounce towards some higher levels like around 132, 133 for the next resistance level. Okay, next one is on Intuit. Okay, for Intuit, I think for now, looks like some returning of the trend. So previously it was an uptrend and then it started to just trade in a range. But over time, we see that there's lower highs along the way being formed into a key support at around 620. So it's another test of support on Friday. Could see another bounce, but I would expect this lower high trend to actually continue with shorter ones resistance could be around 635, 636 around there. Yeah. Then if this key support breaks down, then the next support to look out for will be around 595 around there perhaps. Okay, what's your view on Sembcorp, Keppel and Franken? Okay, for Sembcorp, there's also I think short-term weakness. Previously was consolidating in this channel over here, and today there's a gap down and break below. So I think short-term wise, I think price could head lower to test this range breakout level, which is around 510 about there. 510. The range 5 to 510. Yeah, if you could just consolidate around here, then yeah, about there. So quite similar to Keppel's chart. Then as for Franken, let me take a look. Okay, Franken, I think is still showing some signs of weakness. The 160 swing low support looks like price is unable to hold over there, still resisted along this downtrend resistance line, lower highs. So I'll expect price to actually just gradually hit down lower towards a test of the lower support level, close to 150 about there, before it starts to trade sideways. Okay, next one is on Capital Sanders REIT. Okay, for Capital Sanders REIT, I think this previously I had a technical buy call on that. But it looks like I think this trade probably invalidated for now. The back test of around this 273 was able to hold this support level, and then price just went below. So I think for now we are likely to see a retest of this 265 previous double bottom level again. Then we might see a small bounce, but I would say the slightly be limited around 270 to 273, likely see some resistance again. Okay, next one is on iFast. Okay, iFast, I think for the time being, I think it could just be range consolidating. Around resistance rate around $7 about there. Recently we tested it and then we had a pullback. So I think price could go back towards this range support level, which is close about 670 about there. Then we see some consolidation again. Okay, next one is on AEM. Okay, AEM recently some rebound. I think for now some upside should be quite limited, I think, because of some resistance close to 257, 250, 257 area. So previously there was this range support breakdown here. Should act as a resistance. Then but price recently broke above this 240, 242 resistance level, which currently acts as around the support. So probably some range bound move here, I would guess. Okay, then for the three local banks, okay, first I'll start with DBS. Okay, DBS, I think share price movement recently has been quite range bound. For now, around the $36 mark is the resistance. Support wise, still around 35.30. I think for the time being, likely some range consolidation to take place. And as for UOB, yeah, the chart is quite similar as well. So currently you can see is a range consolidation resistance 29.70 about there. Yeah, 29.70. Then the support is around 29.20. So I would think it's likely still some. It's also going to do the bit of a consolidation for time. Yeah, next one is OCBC. Okay, OCBC also around the same as well. 1380 is a resistance. Currently support is around 1350 about there. So perhaps a little bit of a pullback towards this support again, then it bounce up. Yeah, so all three local banks are currently just trading sideways in the consolidation. And looking at the Straits Times Index, I would say some weakness recently. Still, price is still unable to break above this trend line, this key trend line over here, finding resistance from the swing highs around the 3,250 level. Then also today price broke below this 3,200 level over here. So if price continues to stay underneath it, we could see some short-term pullback towards another support level, which is around 3,150 about there. Yeah, so but I think in the near term wise, probably we're still seeing price consolidate in this general main wedge pattern over here. Until there's a clear break either way in terms of direction wise. Okay, then for Samudra Shipping, I think for now, likely to be still some trend continuation going on. See higher highs, higher lows after breakout of 79 cents. Also, also managed to clear this 84 cents previous range support level breakdown as well. So as long as this level can hold, I think price could still trade higher. To retest higher levels like around 90 cents to 92 cents level. Yeah. And then there's a question of venture. Venture, I think nothing too much. Overall, still okay trading in this uptrend channel. Over here, recently price broke out of 1440 horizontal resistance. So if that holds, I think like we could still see price continue to trade higher towards the next key resistance of about 14.90 to $15, which was a prior swing high horizontal resistance as well as the current uptrend channel resistance as well. The next one is on UMS. Okay, UMS, I think still nothing too much as of now. It's been a few weeks. It's just stuck in this range between 132 to about 138. So I think, yeah, I would say I think just be continue likely. It will be likely that this continues for the time being. Yeah. And we also have this trend line support over here, which is confirming our range lows as well. So probably just you will likely find some support. If it does test this level, then just rebound towards the range resistance again. Okay, then there's next one is a question on BYD. Okay, BYD, I think for now, yeah, still likely to still see some range consolidation. Also, okay, so because recently price did a rebound from this trendline support, then yeah, face resistance from this recent support breakdown around 211. So I would expect some range bound consolidation still. Near term support wise should be around 200, 201 this level, this horizontal level. So I'll expect price to just trade sideways for the time being. Okay, then next one is on BYD electronics. Okay, for BYD electronics, I think chart wise it still looks quite weak. Recently we had there was a breakdown of this key support around 2820, 2030. Then recently price retested this support around 26. I think this must hold to do some rebound, but I would think that the rebound is likely to be weak as well. The recent lower highs created over here, as well as the breakdown of this key support. So yeah, I would say limited rebound upside. Price I think over time should likely to be heading lower towards the next support level, which is probably around 2470 should be the next key support. So that's for BYD electronics. Next one is Amazon. Okay, so for Amazon, I think still trading in this still continuing its uptrend, this general rising wedge pattern. Recently, after price broke out above 180, horizontal resistance has been just continue trending higher. We tested the previous all-time high around 188. So for a time being, see some consolidation for a time being, but as long as this trend line, this uptrend support line is still holding it, and then we still continue to see higher lows being formed, I think it should be able to continue its uptrend towards new highs. Okay, then there's a good question on regarding RSI and MACD. So I'll read that out. If both RSI and MACD show divergence, does that mean that it has high probability of price uptrend versus if only one of them show divergence? Between both of them, does MACD divergence has higher probability of uptrend than RSI divergence? Yeah, so that's a very good question. I would say that if both show divergent signals, there's a higher probability of price showing uptrends or downtrends reversals, as they give a more comprehensive view of the market with more indicators. But between both of them, yeah, I would agree that MACD divergence has a higher probability, because when look in terms of the indicator itself, MACD is a momentum indicator. Actually captures the strength of trends, as well as it's more useful to predict when price reversals or likely to take place. Yeah. Then when we look at RSI, is more of an oscillator that goes between 0 to 100, that actually shows the strength of the current price as compared to its historical prices. So I would say that when we are looking in terms of trends wise, MACD divergence has a higher probability of predicting in terms of the trend reversals compared to RSI. Yeah. Okay, then there's a question of digital core REIT next. Okay, digital core REIT, I think for now nothing too much. Looks like they're currently stuck in the range bound pattern. Likelihood is that still resistance acting as 62 cents. Positive is that after double bottom around 55, 56 cents, price has been keeping a higher low at 59 cents support recently. So if can hold these lows over here, then breaks out of the resistance over here, then we could see higher high of 65 cents being formed. Yeah, but for the time being, it's likely to be still range bound. Okay, next one is on Olam. Okay, for Olam, it's been trading in an uptrend recently. I would think that for the short term, we could see a bit of a pullback towards a bit of range consolidation, because price reached about 123 last week, and then previously this was a high over here after following a gap down as well as previous swing low support. So could act as some short-term resistance. So could see some short-term pullback. Near-term support-wise will be around 113 about there, which was a previous high as well. And recently, in terms of price action, it was a level that price broke out of, did a retest and then move higher. So this is a key. This will be likely to be a short-term support. Yeah, so I think probably just retest and do some sideways consolidation. Okay, next one is on China aviation. Yeah, so for China aviation wise, recently price recovered back above the 92 cents level, which was a resistance. Hence it helped this level as well. So yeah, then there was some bounce towards 95 cents, 95 cents to 96 cents was the resistance over here. And some bit of a pullback recent on today as well. So I would think short-term wise likely to be kept in the range between 92 cents to 96 cents area. So we could slightly just consolidate this zone for the time being. Then I think I'll move on to discussions on the 3 US banks that reported results on Friday based on their TA. So first one is on JP Morgan. JP Morgan in terms of the chart wise, you can see there was a gap down and then strong bearish momentum on Friday below this uptrend support line as well, which we rejected at $188. Also broke below this horizontal support 185 to 186. So short term wise, I think we are likely to see some a further pullback towards levels like 179 perhaps, 174 to 175 to 179 would likely be the next key support zone for JP Morgan. So given the current bearish momentum, I see some further pullback to take place. Okay, then next up for Citigroup. Okay, Citigroup, there was a gap up, but then it ended the day lower. So so it indicates some bearish signals as well. Price able to get above this 62.30, 62.40 level still. So the key for now is still hanging on to this trend line over here. If it breaks below the Friday lows, then I think we slightly see a further pullback in terms of price to retest short-term supports like 56.50 to about 57.80 zone over here. Yeah, so the key will be to watch out for today whether it can hold the Friday lows. Okay, the next one is on Wells Fargo. So for Wells Fargo, generally is still keeping on into its range bound pattern over here. Friday looks like a doji candle, but and market is quite undecided. So I think the key for now to continue is to continue its range would be for price to climb. It needs to climb back above this 56.40 horizontal level, which is a support. Then there's a chance of retesting 58. If the lows of then similarly to the other two banks, if the lows of Friday gives way, then I think we could see some further price pullback towards like this is 54 about it. 54, then next key level is around 54 and 52.40 about it. So that's for the US banks. Then next up is on Aztec. Okay, for Aztec, I think I'm thinking price could pull back further because recently it's been quite range bound over here. Then there was some rebound to retest this broken support at $1.02. And subsequently price came down quite subsequently price came down afterwards. Then if price is unable to hold this 98 cents support, right? It's quite likely that price could pull back further towards like around 94 to 95 cents region about there. Yeah. And next one is on Food Empire. Okay, next one is Food Empire. There was some rebound, but then not so positive price action towards the end of the week where it actually broke through this 137 level again. And it did another retest of this 133 lows. I think in overall wise it's still more towards the bearish side. If the lows of this 133 is any a hold, then I think likely we will see price do a further pullback towards this 127 again. Yeah, looks like a lower high and then break of the support again. Okay, next one is Delphi. Okay, Delphi. I would say for now, currently still range consolidation. Price after doing a retest of 95 cents previous support level, there was a pullback, and then some sideways action at this range resistance of 92 cents. I think for now, likely it's still holding over there. If price holds this, it's like it could do a rebound towards 95 cents and just straight sideways. But if it breaks below the lows around the 91 cents level, then likely that price will go lower towards the lower side of the range, which is around the 89 cents support again. Yeah. Okay, is it time to accumulate gold ETFs now? Okay, I think we can take a look at the gold price currently. So actually gold has been on a strong run recently, following a break of this bull flag range over here. But I would say short term wise, I would expect some slight pullback in terms of gold price. Friday looks like some profit taking place, as well as it's starting to trade, possibly trading outside of this short term uptrend channel over here. So if there's a break below 2,330 level, I think we could see some short term pullback towards like 2260, 2270 level. Yeah. And I think it could be a better time to accumulate the gold ETFs when price does a bit of a pullback from this strong run. Yeah, I think there's some questions. There's some question from my colleagues. I think I'll hand back the time over to them to answer them first. Thanks.
I see there's a question on the ETF, Lion APAC dividend ETF. I assume you're asking about the Phillip SGX APAC dividend rate ETF. So currently there are 5 rate ETF listed on SGX. In terms of market cap, this Phillip SG. By the way, this ETF actually the issuer is PCM itself. They actually, in terms of market cap, it is the smallest. The market cap is only 12 million compared to Lion Phillip S Rate and Nikko AM. They're both 300 million plus market cap. The other CSOP and UOB Green ETF, their market cap is around 60 million plus. So in terms of market cap, is the smallest. What set it different from the other ETF? As the name suggested, it focuses on the APAC region. Unlike the other rate ETF. So the only one that also focuses on the APAC region is actually the UOB Green ETF. But that one focuses more on the green aspect, so there's a slight difference on their focus. In terms of expense ratio, their expense ratio is the highest at 1%, compared to their peers is around 0.6 to 0.8%. In terms of performance year to date, I don't have the latest number, but up till late March, they have the best performance, which is negative 2.6%, compared to their peers is around negative 12 to negative 6%. So currently we have not issued coverage on this ETF yet, but we do have plan to do that. So if you want to find out more about the detailed numbers, please stay tuned. We're probably going to issue coverage in the near future. Yeah, thank you. Thank you.
Okay, I think I'll just take last few counters. I see these are close to 1. Next up is on Occidental. Occidental Petroleum. I think short-term wise, looks like is some possibly profit taking on Friday with a high volume. Yeah, if price remains under 69.50 about there, could see some slight pullback towards about 67 to 68 this area, then could just sideways. But overall trend is still currently remaining an uptrend over here. Then this one is on ExxonMobil. ExxonMobil also quite similar. If price remains below 122, then short-term wise, it could be some slight pullback to do a bit of a sideways consolidation. Price could dip to maybe 118 about that. But overall, it's still in the uptrend as well. Next one is on energy transfer. Yeah, for energy transfer, I think yeah, it looks like broken down the uptrend, the short-term uptrend channel over here. Then after price was able to hold 1570 as a support again as well. So I'm expecting some short-term pullback towards towards $15. Perhaps then you could just do a bit of a bounce over there. And I'll take one last one on your Inc. So for this counter, it looks like generally is in an uptrend over here. Recently has been quite sideways. Price, yeah, if it still likely to just trade sideways between 78 to about $80 about there. If you can't hold this 78, then could see some further pullback towards 76. Yeah. I think sorry in view of time, I'm unable to answer all the TA questions. You can feel free to post them in our Poems 3 TA community chat, and I can take it from there. So I think I'll hand over time to Glenn to close the session. Thanks.
Thanks, Zane. Yeah, I think someone asked, I think we reached 1 p.m. already, but someone asked about to flash a slide on the 3-month SORA. Not to worry, all the webinars will be uploaded to YouTube, so you can just look at it, and then if you want the information, you can just pause and you can see the screen. Yeah, so it'll be on YouTube, so not to worry. You can just look for the information there as we have run short of time. So thanks again, everyone. I think I've answered most of the questions. Thanks again for joining us and for our webinar, and I think we'll just end here. Thanks, everyone. Thanks again. Have a good week ahead.